for watching another episode of Insightful Principles. In today's content, I really want to break down fractional reserve banking. What is it? How do banks actually lend out their deposits? I'm going to explain all of that throughout this video. If you all can do me a huge favor, if you could like, subscribe, and share this video, that's greatly appreciated. Don't forget to hit that notification bell below so you can be notified every week when I drop content. So what exactly is fractional reserve banking? Well, it's a system where banks will hold customers' deposits and then they will take those same deposits and they will lend them out as loans to borrowers. Now, banks, they are required to keep on hand a certain amount of cash that customers do provide to them, but they're not required to keep the entire amount. So banks have what's called reserve requirements, and these are determined by the Federal Reserve System that will actually set those specific requirements. And a typical requirement for a bank is usually 10% of their deposits that they have to have on hand as reserves. So for example, let's say that you have a bank, they have $100 million sitting in deposits and they have a 10% reserve requirement. Well, they essentially can loan out $90 million to other customers, and then that $10 million is what they have to keep within their bank at all times. And usually this is just to be able to create more economic activity and more output within the economy, whereas people will have to buy cars or buy a mortgage, buy a credit card, or even starting a business. These are some of the different lending protocols of why they create this product or service with being able to have this fractional reserve banking system. Now, reserve requirements is a monetary tool that the Federal Reserve will use to either increase or decrease economic activity. Now, by increasing the reserve requirement, the Federal Reserve is simply taking money out of the economy and they're increasing the cost of credit. So we're seeing that right now. The Federal Reserve has came out. They have said that they're going to be adamant on raising rates. Therefore, we are seeing credit cards, interest rates are much higher now. Mortgage rates are much higher. If you have an auto loan that has a variable rate, most likely it has went up. So this does play a role with trying to slow down the economy. And the reason why the Fed is doing this is because they're wanting to combat inflation. And these are one of the tools that they will implement. Whereas when the reserve requirement decreases, they're pumping more money into the economy and it's allowing banks to have more excess reserves. And in result, it allows them to be able to expand more of their lending and credit. And they also will tend to lower interest rates so they can encourage more borrowing amongst customers. So you may ask, what is the reason for fractional reserve banking? And it really allows a bank to utilize a bulk of their deposits to help create products around lending and credit. And really the purpose is they're wanting to make money off of your money. You know, if they don't do that, the money is just going to kind of sit and idle in the bank. So they had to create something that will allow them to still participate in lending to help more funds become more available throughout the economy to help increase economic productivity. Now, some challenges with fractional reserve banking is what can happen if depositors all request their money at the same time. This is known as a bank run, and what we had with Voyager, with Celsius, when everyone were attempting to make withdrawals from the account, what did they have to do? They had to put a pause on people's assets and what they were allowed to take out of the account. And when you have a bank run, this is essentially when a bank doesn't have enough reserves to be able to help the people that are requesting those deposits and those withdrawal requests. So if we use the same example that I used earlier when I talked about if you have a bank that has $90 million that is being loaned out and then they have only $10 million that they have in their reserves because of that 10% reserve requirement. If you have a number of people that come to the bank and say they all want to request $30 million at one time, but they only have 10 million sitting inside of their bank in reserves, you can see the imbalance there. That's almost $20 million of a deficient amount they don't have in their account that they can be able to provide to the economy. So I definitely think fractional reserve banking is an important concept, and it really highlights why you always have to have an investor mindset. You always need to be thinking long term, because if banks are going to make money off of your money, you should make sure that you have a plan for your finances, and make sure that you are making money off of your money as well. So I thank you all so much for watching this video and all of your support throughout the years. If you all could please do me a huge favor, like, subscribe, and share to this video. It doesn't hurt at all to do that. And don't forget to hit that notification bell below so you can be notified every week when I drop content. Also subscribe to my Patreon channel, where I create exclusive content around finance, business, and entrepreneurship. And I thank you all so much for watching, and take care.